Hey everybody, before we actually see the trades, I'm going to quickly cover what I look for before getting into a trade, what indicators I use to determine if I think it's worth me jumping in on. These are just recommendations that have worked for me, but obviously you'll need to see what works for you and your trading style and risk tolerance. So there are 4 things that I look for to confirm whether it's a trade that I should take or not. These 4 things together is what has given me a 90% win rate. Kind of fluctuates around that 85 to 90% win rate. Um, and so if all 4 of these aren't working together, or at least 3 of them working strongly together, it typically for me, I found that it just doesn't work. And so I won't get into the trade. So specifically what I'm looking for is typically a reverse in whatever direction the stock is currently heading. So I'm looking for reversals. If it's heading down, it can only go so far down before it has to come up. And if it's heading up, it can only go so high before it has to come back down. You've probably never seen a chart that's just a straight line in one direction or the other, right? It always goes up, has little reversals before it even continues on an uptrend or a downtrend, whatever it is. I'm also looking for a continuation. So if it's moving down or moving up, does it still have some room to continue moving in that direction? And these 4 indicators have really helped me find both of those things. So I'm just going to go through these quickly, and later in the course we'll actually see all 4 of these in some different example trades that I recorded. So this chart here, you actually see this on each of the 4 things that I go over. And actually I throw in a 5th one as well. But you'll see this chart for each of them. It's just because it's a really good example of all 4 of those indicators coming into play. So I'm going to go through each one of them. And again, you'll actually see this exact chart traded at the end of this unit. But this is a 1-minute chart, which just means that, so you see that right up here, it's a 1-minute chart. And that just means that each of these candlesticks here, these each represent 1 minute of trading. And if you're not familiar with candlesticks, you'll want to do some further study on them, specifically with reversal patterns and continuation patterns. And there's a lot of different patterns and strategies that you can look up around candlesticks. So definitely something you'll want to do. You don't want to depend solely on candlestick patterns, but they are a very accurate way of seeing what a stock may do. And you definitely want to have a basic understanding of them. So I'll show you a few patterns here, but just briefly, the red candlesticks, so these here, these mean that the minute or day, if it was a day chart, that means whatever time frame they represent has closed lower than it opened. So the top of the body right here is where it opened, and the bottom is where the minute in this example closed. The wick, which is the part coming off either the bottom or the top of the candlestick, means that it tried to go higher or lower, but then came back up or down. So this one here, it tried to go higher, and then it pulled back down to here. So that's why it has this this top wick. This one here tried to go lower, and then it pulled back up, and so that's what these are called. These are wicks, and that's what they represent. And these are really important as it shows a potential change in direction, which you see really clearly here. It's starting to go up, went up higher, and when it failed, it changed direction there. So, these are obviously very, very important. All right. So the first of the 4 things that I'm looking for is the CCI, and that's the Commodity Channel Index. Some people use the RSI, some people use the CCI, or both. But basically what the CCI is, it's just showing what the average or the expected price of a stock, what that's been over a certain period of time, and where it currently is in relation to that average. So right here, the 0 line is average. And then if it's oversold, it's going to be up here. If it's if it's oversold, it's going to be down here. If it's overbought, it's going to be up here. So again, it's basically just showing what its average is and where it is currently in relation to that average. This is a leading indicator, which means that it'll generally tell us what's going to happen before it happens. Where some indicators only confirm the direction it's already moving. And like I mentioned, 0 is its baseline. 100 right here is overbought, and 200 is extreme overbought. The other direction, like I mentioned, negative 100 is oversold, and negative 200 down here is extreme oversold. And typically I'm looking for it to get as close to 200 or negative 200 as possible for a trade, but 100 or negative 100 can definitely work as well if the other factors I'll be showing you are present as well. But I mean, you can see here both times it got to, or even above 200 were pretty big reversals right there. Both of those are easily enough for a 5% gain. And the other way, when it got to negative 100 right here, is when it reversed. And I'll show you later how volume really plays into that as well. And next is the trend. So is it overall bullish? Is it moving up? Or is it bearish? Is it moving down? And the reason why this is important is because we're actually able to make money when the stock moves up or when it moves down. And we'll see that when we look at the chart and when we actually see some trades later on. But if it's a bullish day and it's trending higher, we're going to be looking more for getting into a trade that's going to make money on the way up. And if we see a good setup to make money on the way down, we're going to be much more cautious because we'd be betting against the trend at that point. So if it's really bullish that day and we're trying to make money on the way down, it's just something we can still do, but we just want to be more cautious going into a trade like that. But with this strategy, we're also looking for a change in trend, or at least a pullback before continuing. These are called reversals again, like I mentioned. Like here, it started higher, but then pulled back before continuing higher, then reversing again. Like we saw with the CCI, we can at least somewhat gauge when it's going to start reversing using that indicator. This chart, it's still trying to find its direction. It's more trading sideways, so it's a little harder to tell. But if it's clear, if it's clear one way or the other, you want to be careful trading against that trend. And volume is showing us the volume of trades that are happening over a given time period. So if the trend has been moving down and the CCI is showing us it's below average, so like here, it's moving down, the CCI, it's below its average here. And now we see the volume, the amount of trades that are moving the stock down is getting less and less. That's telling us that the ones moving the market, moving the stock price, are seeing that this is too low. It's not going to move much lower than this, most likely. And so right there, we're going to start looking for a reverse in direction because, this volume on the downtrend is really decreasing. So they're losing steam. So that's when I'm going to start looking to get in on a reversal. And then here you see the volume increasing on the buyers just to, and this is confirming a reverse in the direction. So you can see how important volume is, to include in those other factors. All right, and the last one is actually one of the most important, and this is one that a lot of retail traders, which is us, end up missing. The reason why this one is the most important, in my opinion, or at least one of the most important, is because this is what the market makers, the institutional traders, putting down hundreds of thousands of dollars or millions on a trade, are looking for. There are price points that you'll see a stock all of a sudden stop at, and then all of a sudden move in the opposite direction. And if you're looking at a chart, it might seem senseless, like why is it all of a sudden just stopping here? But there's a reason why it's stopping there. And it's called support and resistance. It's a price supporting it from going lower or resisting it from moving higher, like these here. So there are two things that'll generally do this. The first is called whole number theory. And these are major price points, like a stock hitting $90 or $95, or a big one would be hitting $100. You'll see it either stopping or, at minimum, pausing before breaking through a major price like that. But you could see that even at the 50-cent marks, and you actually do frequently. And that's not 100% of the time, but it is pretty common that'll happen. The other, and these you'll see happen all day long, are previous support and resistance levels, namely the highs and lows after market the day before, where it closed the day before, and the highs and lows before the market opens for the current day. And this is actually the 5 to 10 minutes of prep that I was saying that I do in the morning. Literally just marking out the levels it stopped at heading into the day. And it's going to respect those levels of support or resistance all through the day. And again, that's not 100%, but in my experience, it's pretty close to that. It's pretty wild to see. And and as the day goes on, I'll mark out any new levels of support or resistance as well, because those will usually end up being used later in the day also. And like I said, you'll really be shocked seeing how accurate it is. Like this one here is one that I had marked out before the market opened, and this was the high before the market opened. And you see it literally stopped on this line. I didn't make this after the fact. I made this, before these minutes even happened. This was earlier in the day, and it literally stopped right here twice. And if I hadn't marked that out, I would have no idea it was going to stop there. It's pretty awesome to see the lines that you've drawn in the morning being respected throughout the day. I mean, it almost seems like, wait, is it stopping because I put the line there? But no, it's just because that's exactly what they're looking for. And so if we're not doing that, we're kind of just having to guess, okay, where is this going to go to? Where's it going to stop? And, obviously, again, this isn't 100%. This isn't guaranteed that this is going to happen, but it does give us a lot more knowledge to go off of. And this one, it wasn't on the list at the beginning, but I wanted to add it in just as an extra one. They can really be a powerful support or resistance level for the 1 minute chart. I've added the 9 EMA as well as the CCI and volume to the charts that you'll be able to import into Thinkorswim in one of the upcoming lessons here. And I'll show the 9 EMA as a support and resistance level in a trading video later in this unit. But that's just this line here. And again, you can see it, being respected pretty often as well. So definitely one that I would recommend having on a chart. If you're doing a smaller time frame like the 1 minute chart and you're doing active day trading. All right, I know that's a lot, but these really can make a huge difference in your trading if you really learn them and put them into practice. Obviously, it's not a guarantee that you'll all of a sudden become profitable, but these are some of the main things that have given me the consistency I've had in trading. And when you look at some strategies, there are, like 5, 10, or even more indicators and studies on the chart, along with lines drawn out everywhere. It's just too complicated, in my opinion. You just need a few that work, that you can get confident using. And just remember, you can come back and watch these videos as many times as you need to. And I would definitely recommend doing that until you're confident in your trading style. All right, I'll see you in the next lesson.